Hi friends, welcome to our channel. Almost everyone keeps their money in a bank. We believe the bank is the safest place for savings. In return, the bank gives us some interest on our deposits. But have you ever thought about one simple question? If banks are giving us interest, then how exactly do banks make money? What is their real business model? To understand this, we need to first break a common myth. Many people think banks just keep all the money locked in a vault like a safe box. But in reality, banks do not keep your money idle. They do not store it like gold in a locker. Instead, banks actively use your money to run their business. The main way banks make money is through lending. When you deposit money in a bank collects money from millions of people like you. Then the bank gives this money as loans to others. These loans can be home loans, car loans, personal loans, business loans, and more. On these loans, the bank charges a higher interest rate than what it pays to you. Let us understand with a simple example. Suppose you deposit 100 rupees in a bank. The bank pays you 4% interest per year, so your money becomes 104 rupees. Now the bank gives that same 100 rupees as a loan to another person at 8% interest. That borrower pays back 108 rupees. The bank gives you 104 rupees and keeps the extra 4 rupees as profit. This difference is the main source of income for banks. This system works on a large scale with millions of customers. But here comes an important problem. What if many people suddenly want to withdraw their money at the same time? The bank cannot keep all money in cash because most of it is already given as loans. This rare situation is called a bank run, and it can create serious financial stress for banks. To avoid such problems, the Reserve Bank of India, also known as RBI, controls banks with strict rules. One important rule is CRR or cash reserve ratio. This means banks must keep a small percentage of deposits as cash with RBI. Another rule is SLR or statutory liquidity ratio, where banks must keep a part of money in safe assets like government bonds or approved securities. These rules make the banking system stable and safe. Even after following these rules, banks mainly earn money from the interest rate difference. This is called net interest income. And when we compare it with total assets, we get net interest margin, which shows how profitable a bank is. Apart from loans, banks also earn money from fees like account charges, ATM charges, penalty fees, and service charges. Another important income source for banks is investment. Banks do not only lend money, they also invest in government bonds, stock markets, and other financial instruments. This helps them earn additional income and reduce risk. Now let us understand risk in banking. Sometimes borrowers fail to repay loans. These loans become bad loans or NPAs. If NPAs increase too much, the bank can face losses. That is why banks carefully check credit history before giving loans. A healthy bank always keeps NPAs low and maintains strong loan recovery. To understand this better, we can look at two types of banks: public sector banks and private banks. Public banks like SBI have huge customer bases and strong government support. Private banks like HDFC are more focused on profit efficiency and faster decision-making. Both work on the same model, but their performance and strategy can be different. Finally, the banking business is actually very simple in concept but powerful in scale. Banks collect money, lend money, manage risk, and earn from the difference in interest rates. They also earn from fees and investments. This is the foundation of the entire financial system in any country. So next time you deposit money in a bank, remember that your money is not sitting idle. It is working in the economy through loans, investments, and financial growth. PLS, do like, share, subscribe.